This report from HSBC issues a highly aggressive buy rating on SK Hynix, projecting a target price of 2.9 million Korean won and over 50% upside. To understand how they arrived at that number, we need to deconstruct the financial modeling and the physical supply and demand mechanics driving their thesis. The gap between HSBC's target and the rest of the street comes down to duration. They are projecting operating profit margins that remain higher for significantly longer than the broader market expects. This comparison table breaks down the exact discrepancy. It maps HSBC's proprietary estimates directly against the current Bloomberg consensus for operating profit. Look specifically at the estimates extending out to 2027. HSBC projects operating profit 13% higher than the rest of the street. HSBC identifies the source of this gap as a market-wide miscalculation regarding the compounding effects of what they describe as a dual-engine supercycle. That dual engine is built on simultaneous, sustained price hikes in both conventional DRAM and advanced high-bandwidth memory. Investors have an opportunity for alpha because the market hasn't fully priced in the permanence of these higher data center spending levels. The foundation of this cycle starts with macro spending. Major U.S. cloud service providers are accelerating, rather than retracting, capital expenditure on data center infrastructure. These charts illustrate the raw scale of that spending, tracking projected CapEx consensus trend lines through 2026. Notice the sustained upward revisions on the red trend lines, pointing to a 70 to 80% year-over-year growth marker. Market skeptics view this surge as a speculative bubble, but HSBC's analysis shows this capital expenditure is justified by clear returns on invested capital. The mechanics of that return are straightforward. As agentic AI utilization rises, the actual compute cost per token is dropping substantially. That improving return on invested capital is what makes these multi-year data center buildouts financially viable. To support that buildout, the physical architecture inside the data centers is undergoing a shift. The ratio of AI to general-purpose servers is rapidly converging. This creates a massive new baseline for memory density requirements. Because this capital expenditure is justified by tangible returns, it creates a durable, multi-year demand floor for SK Hynix's premium memory, shielding the company from typical macroeconomic cycles. To meet that new data center demand, SK Hynix has to physically restructure its production lines. They are aggressively pivoting away from legacy products to prioritize high-margin, high-bandwidth memory, or HBM. These charts capture the scale of that pivot. The total HBM market is forecast to grow at a 125% compound annual growth rate through 2027, driving massive projected sales jumps for SK Hynix. But silicon wafer production capacity is finite. It is a zero-sum environment on the factory floor. This creates a capacity cannibalization effect. Production lines previously dedicated to standard PC and mobile DRAM are being converted to server and HBM lines. Converting that capacity forces a severe supply vacuum in the conventional PC and mobile markets. These charts forecast the inevitable result of that vacuum: consecutive, uniform price increases across server, mobile, and PC DRAM. Contract prices are climbing in cascading increments of 5, 8, and 10%. The AI buildout is effectively starving the traditional memory market. By constricting supply, it forces price increases across SK Hynix's entire catalog, from legacy modules to premium chips. When you translate those sweeping price hikes from the factory floor to the balance sheet, the impact on the bottom line is drastic. This table details HSBC's updated forecasts for SK Hynix's profitability. Isolating the new operating profit margin for DRAM reveals a staggering level of sustainability: 86% in 2026, holding steady at 86% through 2027, and staying at 78% into 2028. That sustained margin is exactly what creates the 13% divergence from the street consensus we saw earlier. The traditional memory cycle usually follows a sharp peak and a rapid decline. This new dynamic stretches that cycle into a prolonged multi-year plateau. It is the sheer duration of these ultra-high operating profits, holding near peak levels deep into 2028, that breaks traditional valuation models and justifies a higher multiple. To value a cycle of this length, we need to look for historical moments where memory demand decoupled from its standard 3-year rhythm. The closest analog is the period between 1990 and 1995, widespread household adoption of Windows 3.0 drove a massive, sustained surge in personal computing. Because the current AI server cycle is operating at a midpoint similar to that 1990s boom, standard near-term valuation metrics fall short. Instead of relying on near-term noise, HSBC shifts the valuation reference period outward, anchoring to the 2027 to 2028 average book value per share. This final chart tracks the historical relationship between price-to-book multiples, DRAM margins, and return on equity. Notice the direct correlation between the forecasted 91% ROE in 2026 and lifting the target price-to-book multiple to its historical peak of 2.8. Applying that 2.8 multiple against the expanded return on equity yields the mathematically derived target price of 2.9 million Korean won. Record cloud provider spending combined with physical capacity cannibalization stretches peak margins far beyond historical norms. This leads to a higher valuation floor and a 54% upside. This video is for analytical purposes only and does not constitute any